The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
On today's episode of Tax Trails, we're talking all about credits. We'll talk about what a credit is, the difference between refundable and non-refundable credits, and general business credits. Here are your hosts, Derek and Spencer.
Hey guys, welcome back to another episode of Tax Trails. So, one thing, wanted to give you a quick update on a couple of due dates coming up. March 15th is the filing deadline for our flow-through entities, S Corps and partnerships, and April 15th is going to be for our C Corps and individual income tax returns. Make sure you get an extension filed beforehand if necessary, or make sure your return is filed by that time. And I'll hand it over to Spencer to get us started today.
Thank you, Derek. So today we're going to be talking about credits. First of all, really what is a credit? In our last episode, we talked about deductions, right? And so I think some people get mixed up, well, what's the difference between a deduction and a credit? A deduction, as we talked about, let's just say we have $100,000 of business income, and we have a deduction of 50 grand, let's just say.
Okay,
Our taxable income is then 50 grand, and that's what you're taxed on, right?
got it.
Now, let's say, reverse it to we have a $50,000 credit. So our income is 100 grand, which means our taxable income is 100 grand. And then we take the taxable income times it by our tax bracket. Let's just say for C Corp, it's 21%. So it's like
$21,000.
exactly $21,000. Then with that 50 grand of a credit, we actually go below that. It's more than 21,000. So now our tax liability is zero.
Yeah,
Right. So
potentially a refund.
yeah.
Got it.
And so with a credit, it lowers your actual tax liability dollar for dollar, whereas a deduction, it lowers your tax liability, but not dollar for dollar. It's a prorated amount, whatever your
Tax affected amount, so to speak.
Yeah.
Right? You could multiply the deduction times your tax rate, and that's kind of how you can come up with a benefit of what that deduction is.
Exactly. So really a credit is way better than a deduction because it's just worth more. It has more weight to that number.
One other thing I'll say is you can kind of think of a tax credit like a tax payment. It's as though you're taking dollars and paying down your tax liability with a credit, but it's not necessarily, it's not actually cash coming out of your pocket directly to the IRS.
Yeah, correct. You're not making like an estimated tax payment. It's just something that you are able to receive because of different expenses that you've had or however you qualify for the credits. And we'll talk a little bit about some credits that general businesses can use and whatnot. But going off of refundable versus non-refundable, so those two words are not interchangeable, even though they're very similar, right?
Got it.
And so a refundable credit just means that if a credit takes you past zero tax liability, and then there's a refundability portion of that credit, you can actually get that refundable portion paid back to you. So if you have a $5,000 refundable credit, but your tax liability is zero, you can get $5,000 from the government essentially
Oh, cool.
on your return. Whereas if you had a non-refundable credit of $5,000 and your tax liability was zero, then your non-refundable credit doesn't do anything for you.
You might lose out on it entirely. In some cases, they can roll forward and maybe you can take it at a later date, or sometimes that's it.
Yeah, sometimes you just lose it and it hurts. But that's the difference between a refundable credit and a non-refundable credit. And some credits are non-refundable only. Some credits have a refundability portion in it. We talked a little bit about the new tax law that is trying to be passed in the House and the Senate. That was our first episode. And part of the change was the refundability portion of the child tax credit. And so not necessarily the non-refundable part, but just the refundable part of that tax credit. So that's the difference between a refundable versus non-refundable credit. And we kind of wanted also to talk about just general business credits. There's a list that the IRS has that we'll link in the show notes of just general small business tax credits that people can use. Some of the ones that we wanted to talk about today, we talked about pass-through entity tax last time on the deductions podcast that we did. Pass-through entity tax, you get a tax credit on the state side for however much you pay to the state on your federal return.
Got it.
EV credits, we're going to dive a little bit more into that later on in the episode, but it's essentially credits that you get for purchasing an EV, electric vehicle. There's also work opportunity credits, which are credits for employing people that fall into a targeted group. There's like 10 target groups that the IRS has, and if you employ people in those groups, you can get a credit. There's the R&D credit, which is pretty big. It's at least in my field of tax that I've done in the past couple of years, a lot of returns that I've done have had the R&D credit, which is just research and development credit, where you get a credit based upon how much money you spend researching and developing new processes and so on and so forth. So there's the R&D credit, and then there's also foreign tax credits, where you get a credit for paying foreign tax on foreign income. A good thing to remember is for C Corps, the credit stays with the business. So if you own a C Corp, your credits will stay at that entity level. However, for pass-through entities such as S Corps partnerships, your credit will flow through to you on your K1, where then you will be able to pick up the credit if you can. Some of these credits, like we talked about, are non-refundable. And so on your personal return, if you don't have that tax liability, then the non-refundable credits can be lost.
Got it. So you'll incorporate it, figure out whether or not you're going to be able to utilize that credit on your individual income tax return, and then that's ultimately where it ends up, one way or another.
Correct. Yeah, and that's why the business returns, a big reason business returns are due before personal returns, like March 15th for flow-through entities at least, and April 15th for individuals, is because you need that information from the business to finish your personal return. And so it just comes from your Schedule K1 that you get.
Maybe we should talk about that sometime.
I think we will, actually,
right.
maybe.
Cool.
But yeah, so those are just pretty much the general credits that we wanted to go over. Specifically, though, that apply to probably more people who are listening today is some clean energy credits that the rules have been shifting a little bit throughout the years with the different tax law that our Congress and politicians have made. The first one that we wanted to talk about is energy efficient home improvement credit. This is a non-refundable credit. So going back to non-refundable versus refundable, if you have no tax liability, then this credit is not really going to help you at all. But it's a non-refundable credit. It applies to putting in exterior doors, windows, skylights, insulation, central air conditioning, water heaters, furnaces, boilers, heat pumps, just essentially things that you're putting into your home that makes it more energy efficient. And so the amount of the credit is a percentage of the total improvement expense in the year of installation. For 2023, it's 30% is that percentage, up to a maximum of $1,200. There's some other rules and stipulations that apply, but that's an overview of the energy efficient home improvement credit. I think for a while it was done away and it didn't matter, and then they brought it back. It's kind of just been something that's going back and forth, but now it is here for 2023. And so that's something that people might want to look into, might not. It's something that you don't want to buy. You necessarily don't want to make your whole home these energy efficient improvements just to get a $1,200 credit. I don't think people should only do things based on tax consequences.
I strongly agree with that. That's one thing I like to talk to my clients about. Don't let the tax tail wag the dog, right? Like, make your decisions based on if it's a good financial decision in the first place, right? Like,
yeah.
If you're going to get a benefit from this other than taxes, that kind of should be what drives the decision. And then, oh, well, maybe we can augment this decision based on the tax consequences from there.
Yeah, there are definitely circumstances where you do want a more tax focused mind when you're making a decision.
Sure.
But in these sorts of like credits that we're talking about, this isn't really one of those areas because you're just improving your energy improvements to your home, right? And so you don't want to say, hey, we should spend $50,000 on these energy improvements so that we can get a $1,200 non-refundable credit.
Right.
That
Yeah.
just doesn't make any sense.
Yep. Yep. Especially when the max benefit you're going to get is $1,200, right? And then when you're talking about some of these improvements could be, like you said, 50 grand or more, right? So that's not the right way to look at it. But you could do it from another point of view. There might be people who are really concerned about just energy efficiency in general, right? They want to be
Right.
green and they want to do these things, and if you make your home more energy efficient, hey, you're probably going to save some money on utility expenses throughout the year, and you stack that up over multiple years, right? You're going to see some other savings. So there are other reasons to do things, but um, yeah. Anyways, you want to look at everything in a holistic approach. Don't always look at it just from that. Oh, look at this $1,200 tax benefit.
Yeah. Which kind of goes on to our next point of view of residential clean energy credits of like solar, right?
Yeah. Yeah, exactly. So solar, man, it's like every other day you see another commercial for a solar credit, right? You ever gone onto a YouTube video and like 50% of the time, what's the ad gonna be?
I always get that one about like Utah home. If you're a homeowner in Utah, you probably don't know that your solar energy is yada yada yada.
You're gonna get this and this and this, and somebody else is gonna pay for it.
Yeah, it's like it's totally free or something like that. Yeah,
Yep. So there's lots of stuff out there about solar credits. I'll give you a little rundown. So where solar credits fall into, it's called the residential clean energy credit, and similar to the energy efficient home improvement credit, it is also non-refundable, right? So I'll run through a couple of things that you need to do in order to qualify for this credit. So the first thing is it's got to be new clean energy property. Okay, and what qualifies as clean energy property? We've got solar, wind, and geothermal power generation, solar water heaters, fuel cells, battery storage. So those are some of the things that are going to qualify for that residential clean energy credit. So,
yeah.
oh, go ahead, Spencer.
Well, I just think it's interesting too, like fuel cells and battery storage. Like you don't really think of that when you're thinking of like solar, like putting solar panels on your home.
Yeah,
You can put solar panels on your home, install it, and then maybe a couple years later you want to add more battery storage. Right?
yeah, for sure.
So a couple years later, you can put battery storage, and then that also qualifies as residential clean energy because it's a new property, right?
That's right. So one thing to keep in mind, and you mentioned it above, you're going to get this credit based on the year of installation. So if you're getting something done, in December or something, it's really important that you get that finalized before December 31st, right? So you can get that credit if you want. I was going off a minute ago about not doing things just for a tax credit, but
If you're already going to do it,
if you're going to do it, exactly, might as well get it done. So the way this credit is calculated, similar again to the energy efficient home improvement one, but so you get 30% of the total cost of the improvements, but there's no annual maximum. So you can get 30% on $100,000 of improvements. You can get a $30,000 credit. You know that there's a possibility here where you could generate some really massive credits. One thing to note though, it's got to be on your main home. It can't be a rental. You've got to live in the home, and there are some potential qualifications if you have a secondary home that you're doing this on, but there's a few more boxes you need to check in order to qualify for that credit.
yeah. And I would say, kind of just as a heads up for anyone who's getting solar companies are here today and gone tomorrow. And
Yes.
I've done a lot of, I don't, maybe I shouldn't say a lot, but I've done returns where have filled out for clients to get this solar credit, this residential energy credit, and then they're trying to figure out how much they spent for it, and they're reaching out to to the people who put it in, and it's dark. It's hard. So whenever you do get solar, make sure that you get everything you need from the construction people or whatever company that you're using, because you never know later. Like if you get solar in January, February, maybe the first half of the year, that company might not be there the second half of the year.
That's absolutely right.
And so you want to make sure that you get all of your stuff, all the information when they're still there. If that makes sense.
Yeah, and one other thing I want to mention is, when this solar company comes and sells you solar panels for your home, they're going to factor in the cost of they know about these tax credits. They're going to factor it into whatever sales pitch they give you. So they might say, "Hey, your cost on this is going to be X," when really your cost is going to be Y, because they're already taking into account, oh, you're going to get this 30% tax credit. And the other thing to remember is, like we said, this is a non-refundable credit. So if you don't have sufficient tax liability to benefit from that credit, you lost it. Their benefit is gone.
Yeah, and even if, like you said, like if you get $100,000 new solar panel stuff, and if you don't have the tax liability to back up the credit amount, you're just losing out on that credit, right?
Exactly. All right, that's enough on that. So, Spencer, how about you tell us a little bit about the new vehicle credits?
Yeah, so I think this is one that a lot of people have heard about and looked into. It's definitely advertised by, especially like Tesla and Rivian, I know is another EV.
It's exciting.
Yeah, it is exciting. Well, it's like the new wave, right? It's like,
Absolutely.
ditch gas and go electric. And I think this is part of the thing. We talked about this in an earlier podcast about how policymakers and the government will write tax code to help incentivize people to do things, right? And I think
Yes.
this is one of those ways that that our government has tried to incentivize people to buy more EVs is because of this new electric vehicle credit. Again, it is non-refundable, and you can qualify for up to $7,500 if you meet the requirements. There are some specific requirements. There's also some AGI limitations or adjusted gross income limitations. So not everyone can get this credit. If you make too much money, you just can't get the credit, right?
Got it.
And it also depends on how much your credit is, depends on, at least for 2023, depends on when you placed it in service. So if you placed it from January 1st to April 17th, there's a specific calculation of the credit. However, if you placed it in service April 18th to the end of the year of 2023, there's a different calculation of the credit. And so it just kind of depends. So if you're doing your taxes, you're filling out your 1040 in your tax preparer, and you tell them, hey, we just bought this new electric vehicle, they're gonna ask you for your VIN. They're gonna ask you what vehicle it is. They're also gonna ask you when did you place it in service, because that takes into account what your credit is. Again, doesn't matter which part of the year you get your car. It's this max is still $7,500. It's just kind of calculated differently depending upon at what part of the year you get it. One of the interesting things is there's an MSRP requirement.
Yes.
So I don't know if anyone listening has remembered Tesla. I don't know, a year ago, maybe 2 years ago, they lowered the cost of a lot of their EVs, and some people who just bought a car were upset because they're like, I just bought this for like 80 grand and now it's like 50 grand. Like, what's up with that? Part of the reason why, and I don't know all their supply chain, costs, and internal stuff, but from what I've read online, some people think that part of the reason why they did it is because of this MSRP limitation. So if for vans, SUVs, and trucks, if your electric vehicle is more than 80,000 MSRP, it doesn't qualify for the credit. All other vehicles, it's 55 grand.
Okay.
So that's part of the reason, I think at least, why Tesla lowered their vehicle amounts. And I don't know, this might be tinfoil hat. Maybe the government didn't want them to, price their vehicles so high because they wanted just more people to buy.
Got it.
But there is an MSRP limitation, which shouldn't. I think a lot of companies see that, and so they've priced it under. But just be aware of that.
One thing that's interesting with that is MSRP. So you might go to a dealer and you might see that they've got a bunch of excess cars on the lot because, that particular model might not be selling well. So that dealer might say, "Hey, I'm going to knock off 5 grand on the price of this car so you can go ahead, incentivize somebody to buy it." But if the MSRP is still over those limitations, you're out of luck. It doesn't matter.
Yeah, it doesn't matter what you pay for it. It's MSRP based.
Yep, that's
Right.
a interesting little tidbit there.
Yeah, I did think that was interesting. Another part of the vehicle electric vehicle credits is the used vehicle credit, which I think is new, which is pretty new. It's also again non-refundable, just like the new vehicle credit. This credit equals 30% of the sales price with a maximum credit amount of $4,000. There are requirements. It has to be bought for use and not resale. You cannot be the original owner, which obviously, if you're buying something used, you're not the original owner, anyways.
It reminds me of, there's always a reason things are written. And so, somebody's
Yeah.
tried to do something stupid.
Yeah, maybe. Yeah. And so that's one of the rules. There's also another AGI, adjusted gross income limitation, as well. So you might, if you make too much money, you might not be able to get this. And then the sales price, kind of with the MSRP, the sales price has to be equal to or less than 25 grand. This includes all dealer imposed costs or fees not required by law.
Got it.
One thing that I thought was interesting about this credit was that you have to buy from a dealer. And the IRS defines a dealer as someone who's licensed to sell motor vehicles.
Oh,
So if you have a friend who has an EV and he's like, "Hey, you know what? I'm going to help you out. I want to give you this new used vehicle credit. You can just buy it from me." That doesn't work. Unless your
Interesting.
friend deals,
sure.
and they put it on the lot and you buy it that way. But if you have to buy it from a dealer.
That's really interesting. That kind of, makes things a little more tricky for some people.
Yeah, I think they just want to regulate it more and make sure that's not abused from people like disguising a sale. Like,
Yeah.
what if you were planning, like, what if someone was just planning on giving this car and they're like, "Oh, let's just disguise it as a sale and then you can get a credit," and it's like a 2-for-1.
Yeah, that makes sense.
Something like that. I don't know. Another tinfoil hat thing.
No, you're right. If people wanted, I'm not going to, give somebody the blueprint to commit tax fraud here, but yeah, you could come up with schemes to do stuff with your buddies and try to get credits, illegally.
Start selling the same car to each other back and forth year after year and just keep claiming this credit until someone catches on.
Chandler, I said we're not going to give them the blueprint.
Sorry.
So you buy it from a dealer, and then the dealer will report their information online to the IRS, and the dealer should give you all the information that you need to fill out your tax return. Same thing, the solar panel company should give you all the information that you need to fill out your tax return as well. Just make sure that you get all the information. You make sure that they give it to you. But yeah, so that's pretty much the electric vehicle credits.
Got it.
It's not guaranteed to stay. Actually, pretty much all of these credits have been modified within the past 5 years. Some of these credits, the solar panel one, residential clean energy, it's 30% now, but in 10 years it goes down to 26%.
Yeah.
And so it might, in the next couple of years it might change. It might become permanent. The credit might increase, decrease. I have no idea. Another reason why it's, creating this tax podcast is to help with ever-changing tax policies.
Absolutely.
And so you never know. And we'll try and keep up. Well, we will keep up, but keep people up to date on these changes.
Yeah, I mean, these trails wind all over the place, right? That's why we call it the tax trails.
Yeah, and sometimes you backtrack and there's things, it just changes all the time.
Speaking of backtracking, I want to touch on one thing on the solar credits and really even the electrical vehicle credits. There are state credits to consider here. So we're kind of focusing on IRS credits, but in Utah, they have a solar energy credit. And, it's interesting in Utah, in order to actually claim that credit on your Utah income tax return, you've got to get a special form, basically get the installment of your solar panels approved by the state. It's really easy to do. You got to go online and get that form filled out. I think it's called like a TC40E or something like that. And um, I know at one point in time you had to pay a fee, like a $5 fee, in order to get it. You may still need to do that, but I think you can get a $400 credit on your tax return in Utah for that as well.
Oh, awesome.
Then some states I think will have EV credits as well. So something to consider as you're going through your taxes. Look at your state laws, and there might be something there. So moving along with EVs, there's this new in 2024. They've got a dealer transfer credit for EVs. So what is this? This is a unique opportunity for those people buying EVs.
I think it's smart too.
It is smart, and it's going to help people take advantage of this credit, where it's a non-refundable credit, but somehow, in a way, this dealer transfer is going to kind of almost make it refundable for some people, isn't it?
Yeah, it kind of depends. I was reading up on it on the IRS website. It's you have to fill out when you're filling out the forms. You have to like say, I hereby say like this is what I think my income is going to be, so that you can get the credit. And
So here's the thing. So the way this dealer transfer credit works is a dealer needs to register with the IRS, and they register specifically to be somebody who can receive an EV credit when they have somebody come in and buy a car. So Spencer, if you're a dealer, I'm going to come to you. I want to buy this new Tesla. It qualifies for the $7,500 credit, and I want to take a benefit for that credit right now. So I do a thing where I sign over this credit to you, and then you can give me that as a down payment on my car, essentially, and right then at the time of sale. I could do this in March. We're in March right now. I could go buy a car. I could get the benefit of this credit today rather than having to wait to file my tax return
in a year.
in a year. Exactly. So, but here's the thing. You still have to reconcile that you can qualify for this credit. So all the same rules apply for qualification. The vehicle has to meet all the qualifications that are out there. Your AGI limitations are still in effect. So if you meet all those and you qualify to get that credit, you can get the benefit of the credit right away when transferring the dealer. Now here's the sweet part. So you're under those max AGI limitations. You qualify for that $7,500 credit, but you don't have a tax liability of $7,500 or more. What's going to happen? Is the IRS going to say you have to pay me back for that credit? The answer is no, they're not. You just get that benefit. And I didn't realize that at first. I was like, they're not going to do that. But what that essentially has done is turned this non-refundable credit into refundable for those people who maybe wouldn't have been able to take advantage of it. That's a pretty cool deal.
Yeah, that's like a nice little workaround.
It
there.
really is. And the problem is you're going to be dealing with dealers, and you're going to have to negotiate the price of a car, and they're going to factor all this into it. But, I think at the end of the day, it's going to be a benefit. Um, all right. We have a great blog post written on that too. Tyler Van Valkenburg, one of our associates here at Larson, he wrote an awesome blog post. We'll link that in the show notes, I think, and you can go and read some more of the details on there.
Yeah. I will say this as we're wrapping up, that credits are taken before your withholdings. I think that's a good thing to
Oh, that's a good thing to point out, Spencer. Yeah.
remember. So on your 1040, you have all your income items, and then you have your deductions up there as well. So you take all your income, you take all your adjustments, you take all your deductions, like your standard deduction or your itemized deduction. That gets you to your taxable income. Then you take your taxable income, multiply it by your tax bracket, and then you find out that's your total tax liability. Then you take your credits. So you have your non-refundable credits, and then you have your total tax. Under that, it's like a subset, total tax. And then after that, you have your estimated payments, you have your withholdings, yada, yada, yada.
Got it.
So don't be worried about like, oh, if I make such withholding payments, if I make a ton of estimated payments, a ton of withholding payments, then I'm not going to be able to utilize a credit, a non-refundable credit. No, that's not the case. Your credits get used up first before your withholding. Excuse me.
Yeah, so if you had $5,000 of liability and then you had a $5,000 credit and you had 5,000 of withholdings, you're going to get that $5,000 back, right? Because you had the 5,000 liability, boom, you're going to wipe that out with the $5,000 of credit, and now your withholdings, you can get those refunded or you can apply them to a future period if you so desire.
Correct. Yep. And so it's just important to know credits come before your withholdings. You can get your withholdings back if you have enough credits to offset your total tax liability. And your non-refundable credits are also calculated in with all of your withholdings as well. So
Cool.
that's where it's taken in.
So one thing I just wanted to talk about just real quick before we go is, so we talked about how big some of these clean energy credits can get. Some of them can get massive, and there are other credits that we didn't even talk about for people who are making like big solar or clean energy like production facilities or things like this.
Yeah,
right?
or building like residential buildings.
Yeah, residential
45L.
energy credits. There might be companies who generate credits that are like millions and millions of dollars, and they might be in a position where they could never use those credits. And what's really cool is the IRS has come out and they're basically allowing these businesses to sell these credits to other businesses or individuals.
Weird.
Isn't that cool? And I'm not sure how this is going to work. I don't know if there needs to be a broker or what, but the IRS has they put out some publications. They set up a system so the buyer and the seller need to go and register with the IRS for the credit. They enter all the information in about what the credit is and who it's coming from and where it's going to. You report it on your tax forms, but the sale of the credit happens externally to that website. So basically the buyer and the seller, they say, hey, seller, I'm giving this credit to this buyer, and then there you go. And this is really interesting. I don't know if there's going to be a market for this. I think there could be, but imagine you're a taxpayer, you've got a $100,000 tax bill. You go to this company that's got $100,000 of clean energy credits that they could never use because of whatever reason. It's not going to happen. You could say, hey, I'll pay you $90,000 for $100,000 of credit, and you just saved 10% on your tax bill. So
yeah, that I don't know what the limitations would be. It's an interesting discussion though.
It really is, and it's something that's going to be out there. I was talking with one of our tax partners about this. It's really cool. There might be some opportunities here for people. I wouldn't be surprised if a whole market gets made up. I imagine there's going to be some brokers.
Will there be some trailblazers?
Yeah, there might be. So anyway, I want to leave y'all with that. And thanks for listening today, everybody.
Thank you so much, and everyone have a good day.
Yep.
For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.